Okay. So IUL, that is indexed universal life. And so Deb, what that is just a specific version of a universal life policy. And, for newer people, they might say, well, what's a universal life policy? Good question. The two main types of insurance that we sell are going to be whole life, which is permanent, and term, which is temporary. Okay. And generally speaking, whole life is going to be for older folks or less healthy folks. So older and less healthy. Term is going to be generally for younger people and way more healthy people. And so, again, those are generalities. And why that is for term, that's where you're going to see the higher end face amounts. So, if someone's talking about $1 million policy, $500,000 policy, they're generally speaking about a term policy. And the reason being is on a permanent basis, like for the whole life, the insurance companies are guaranteed to pay out that money, right? They never expire. They're permanent. Wow. So the insurance companies don't like to have higher face amounts that they're guaranteed to pay out, right? They are in this to make money. And so because it's lower coverage amounts, they accept a lot riskier clients, right? So for instance would be, if when they're looking at your health for final expense, if you had cancer 2 years ago, they would still accept you, right? They would only require a 2-year wait, or no, I'm sorry, a 2-year look back for you to get first day coverage, if you had cancer. We're on the flip side with those higher coverage amounts with term. If you've ever had cancer, you're not getting it, right? So this begs the question though, of if term is for young and healthy and temporary, and whole life is for older and less healthy permanent, what about the people in the middle? What about someone that is young and healthy that wants permanent, right? Or older and healthy that wants term? This is where universal life comes in. It's basically a hybrid between term and whole life. And what's really neat about it is, whereas whole life and term both have definitive characteristics, I'll say, meaning, if you get a term, it's going to be 30 years, 20 years, 10 years. That's about it. I mean, there are some carriers that might have a 15 or 25, but those are the rules. That's what you're getting. You can't make any changes to that. Just like if you get a permanent policy, it's permanent. That's that. There's no negotiating. The premium stays the same. It stays the same. It's level. You can't ever change it. Okay. Universal is almost a customize your own policy, a build your own policy. And, essentially it's like, well, what if, instead of a 30-year term, what if I have a mortgage that I only have 27 years left on my mortgage? Well, you could design a universal life that'll last 27 years. Now that's rare. We don't really do that too much, but those are the types of things that you can do. Or say there's a 21-year-old that wants $400,000 of permanent coverage. You could do that through universal, right? So essentially how we're doing that is just by how much we're going to have the client pay on a monthly basis. The more money they pay on a monthly basis, the longer the policy is going to last. Okay. So we could have it set up where, essentially if the client wants to pay less, the policy is going to lapse. It'll essentially be a term policy, right? But if they want it to be permanent, we could go in the illustration software and show them what that looks like. How do you create a plan that's going to be permanent? Okay. Any questions on that? Does that make sense of kind of what universal life even is?
So I hate to say this, but I had to like run outside because my dog started attacking a kitten.
Okay.
So I missed everything once I like ran out. I had to go save its life.
Okay.
Sorry.
That's okay. Well, what was the last thing you heard?
You was talking about the difference for whole life and term and what they'd be good for who they'd be good for anyways.
Right. So term generally is for younger people, whole
Yeah.
life generally for older people. And then health wise term, you have to be very healthy for term. And for whole life, you could be less healthy. Right. And so where universal comes in is pretty much for the people in the middle. So say you're, say you're a 30-year-old and you're super healthy, but you don't want term, you want something permanent. Well, universal is going to be a great option for you. Okay. Or say you're older, right? And you're very healthy still. And so, you want, generally the whole life is going to be, 50,000 and below. Well, what if you're 68 years old and you want $200,000 coverage on a permanent basis? That's where the universal comes in, right? Because whole life, you can't accomplish that. And term you could, but you don't want something temporary, you want something permanent. And so Deb, what I was saying is how how universal life actually works is you as the producer design the policy. And I, don't get bogged down, and that's very simple. That pretty much the illustration software does everything. We just tell it what we want it to do, and it tells us how to accomplish that, if that makes sense. So, the example I gave earlier is with term policies, they have standard times, standard terms, right? So it might be a 30-year term, a 20-year term, a 10-year term. But you might be with a client that for whatever reason wants a 27-year term, meaning they only want the policy for 27 years, then they just want it to expire. Well, you could design that in the illustration software, basically just saying, what is the, what do they have to pay for this policy to last 27 years and then for it to expire after that? And essentially, the more money that they pay on a monthly basis, the longer the policy lasts. Okay. So again, does that make sense to everyone? Is that
Yes.
Okay. So that's regular universal life. And another good thing about universal compared to whole life is universal life is going to build a lot more cash value. And essentially cash value is just the equity or collateral that you have against the death benefit. Right. So it's almost the insurance company saying, hey, you've paid in so much, we're going to let you have access to that death benefit while you're still alive. That is what cash value is. Okay. And so universal life, regular universal life is insurance oriented, meaning the people that really all they care about is the insurance. You want to go universal life. Now, there is a version of universal life, which we're going to talk about today, called the IUL, and that stands for Indexed Universal Life. And, essentially what that is that's going to be for people that are more concerned about the cash value, the growth of the cash value, than they are the actual insurance. Okay. And so basically there is a IRS tax code. 7702 is the tax code. And what that tax code says is that life insurance benefits are paid out on a tax-free basis. So any monies that get paid out from a life insurance policy are tax-free. And the certain people took some advantage of that in the beginning, and they had to kind of stipulate Well, then how much money can you actually put into the account so you don't essentially rip off the government of paying taxes, right? And so in IUL, what we're going to do to accomplish really good growth for a retirement program is we're going to, as I mentioned before with universal life, you choose how much you pay into the policy, right? So you choose, again, how long you want it to last, how much money you want to go into that cash value. So all we're doing with a universal life policy, if we're thinking for retirement planning, is we're going to get the least amount of coverage, the least amount of insurance, and we're going to fund it the max that we can based on those IRS 7702 tax code. Okay. And I feel like I might have lost somebody there. Questions about that?
Yeah, just what?
Right. Okay. When I show you the illustrations and stuff, it'll make a lot more sense, right?
Okay.
I just want to give you a general background of what the policy even is, right? And kind of how it works and whatnot. So I guess kind of we have this is, I'll share my screen. Okay. Oh, let me put this over here. So you could find this on the Alliance University on ARC. This is basically a presentation that you could show your clients. Oops. And, I'm not going to go through every page, but can you guys see this PowerPoint here? Okay. Yeah. And so this would be literally what you're showing the client when you're doing an appointment for a retirement account, right? For a retirement program. And, it's a lot of it's the same stuff you would ask about a general insurance appointment, right? We need to know where they are, where they're coming from. So obviously their height, their weight, tobacco use, medications, basically their financial picture. What do they have going on and what are they looking to accomplish? Okay. So kind of how does the IUL stack up against every other retirement savings program? Well, the downside to IRAs, 401ks, 403bs, basically any employer sponsored savings program, I'll give you the pro to them of why people use them to begin with. The pro of why people are attracted to them are the employer typically will match what you're putting in up to a certain percentage, right? So you're basically getting free money, right? So you might put in $50 every month and your employer matches you, right? So you're gaining $50 of free money instantly. Very appealing, right? The downsides to it are, number one, it's tax deferred. And, a lot of people try to sell tax deferral as a good thing. I mean, I guess maybe depending on your situation, it could be. What tax deferred means, Deb, is you don't pay taxes on it now, but you will pay taxes on it later. Okay. And if you know anything about our economy or what our government likes to do, we are consistently raising taxes almost year over year, meaning that it's almost like they don't want you to pay taxes now, but they want you to pay taxes when the taxes are higher. Right. So, you're also going to, the point is this is going to be probably your only income for most people. And my thought process is, well, I want more money instead of less money. I'd rather pay taxes now to have all of my money at the end. Right. But all these other programs don't do that. They do the opposite. With the exception of the Roth and the Roth IRA and the IUL are very similar, but I don't want to go too deep into this. This is mainly about the IUL. And we'll keep going. So again, the IUL, like I said, because of the IRS tax code, those money from insurance policies are tax-free. So you won't have to pay any taxes on this money. Now, they're not tax deferred, which means you're not going to get a break on your taxes today. So essentially you're paying taxes on the seed to not pay taxes on the harvest, right? So we're say you put in, $2,000 this year, you're going to pay taxes on that 2,000, but ultimately we want that 2,000 to grow to 10,000, 20,000, 30,000. And we're not going to pay taxes on the 30,000 when it comes out. Does that make sense? Let's see. And again, you can kind of look at how all this works. There's some examples. Oh, okay. So one of the main benefits and selling points to the IUL is it's called indexed. And what indexed means is your money isn't physically invested into the market. So common indexes that you may have heard of are the NASDAQ, the S&P 500, the Dow Jones Industrial Average. Those are indexes. And what those are is just a collective collection of stocks and bonds and other things that are in all different types of sectors. And it's just kind of a snapshot of what the market is doing as a whole. And so what the insurance companies do is they're not actually investing your money into the stock market, but based on what the indexes do. So as they go up, your money goes up, right? When the market goes down, and this is the cool thing, you are completely protected, where your money will not go down. Your money flatlines. So because your money isn't actually in the market, the money does not go down. You will never lose money in an IUL. And you're going to gain money when the market goes up. So the nice thing about it is you never have to correct your money for when it goes down, right? So when coronavirus started, the markets went down 39%, right? So that means if you had $100,000 in a 401k or in any type of other retirement account, you now lost $39,000 in 1 week, and you're sitting at 61,000, right? And it's like, even if the market goes back up to where it originally was, right? Say it went up 39%. Well, you're still not made whole because it only went up 39% of that 61,000. And so, because it never has to correct, it's going to outperform many times a traditional 401k. So again, I don't want to get in the weeds too much of that. I kind of wanted to show you what it looks like and how it works. This right here is, let me zoom in on this if I can. Okay. So the green is an IUL. The red is just a traditional money market. Okay. So what this is saying is, if in 2000, both accounts started at 100,000. So there was a crash called the dot-com crash in 2000, 2001, 2002. So your 100,000 would have been only worth 59,000 in 2002. You could see your 100,000, you didn't gain any money, but more importantly, you didn't lose any money. So when the market was going down, it stayed the same. As the market in 2003 starts to go up, 2003, 2004, all the way to 2007, you could see that the IUL is going up with it, right? So it matches when it goes up, but it flatlines when it goes down. 2008, there was another major crash, right? So your money, you finally recovered your money all the way back up to right around 100,000, right? Then the market goes down again, and you're back at 61,000. You lost all of that recovery that you had. With the IUL, you're at 143,000 because you only participate in the gains. When the market goes down, you're protected. You don't lose a penny, right? So then from 2008 to 2019 was the best market the country's ever had. You could see that while the stocks or the 401k goes up, so does the IUL, right? So, and a long snapshot is if you would have started in 2000 with an IUL and a 401k, your ending balance, you'd have 325,000 in the IUL, 219,000 in a 401k, right? So that's a very powerful thing to show clients, just because people like to gain and to win and to earn, but they hate losing more than all, right? So if you show people something where they can never lose, it's a very strong selling point. And so the question is, well, how can these insurance companies do that? How can you only gain and never lose? Great question, Ava. So the insurance companies, what they're going to do is for a trade-off to guarantee that you'll never lose money. So to have a floor, if you will, to have protection, they're going to cap what you can gain in the account. And typically it's about 13%. There are other companies and other versions of this product that are probably slightly different than that, but the standard is right around 13%. So, what that means is with the security of the floor. So say the market goes down 20%, your account doesn't lose anything, right? You're still at whatever you had before. And then the trade-off is if the market goes up 20%, they're going to credit your account at that ceiling. So for this example, 13%. So the market's up 20, you're going to get credited 13%, right? And then obviously the insurance company keeps the rest. That's how they're able to protect you. That's how they make their money. That's how it grows. That's how it operates, kind of in a nutshell. Another big selling point to the IUL is with all other government facilitated options, you have to lock your money up. You cannot touch your money until you're 59 and a half years old. And if you do, because it's tax deferred, you have to pay not only taxes on it, but also a 10% penalty for taking your money out early, right? So, you can touch it, but you're going to lose about, depending on your tax bracket, let's say you're at a 25% tax bracket, you're going to lose 35% by taking it out early. The IUL, you have liquidity to it. You could access that money essentially at any time that you want. So yeah, basically what does the IUL give you? It gives you safety, tax-free, good growth, and liquid. And to be honest, it's probably the only retirement vehicle out there that checks all four of those boxes. There's some that check maybe just one or two. The Roth IRA does about 3 out of the 4, but the IUL really is the only one that checks all of them. I mean, it's because of the safety, right? The IUL, as far as, IULs and annuities and bonds are the only thing that guarantee no loss. Okay. So what's the catch, right? What is, it almost sounds too good to be true. And, I usually tell my clients, you're right. It does, right? It's unbelievable. So here is the catch is it is a savings program. So you really want to leave it for at least 10 to 20 years before you start messing with it, right? Because it needs to grow. It's using compound interest. If you start messing with it and taking it out early, you're going to lose all the benefits of why we're even doing it in the first place. Okay. Because it is a life insurance product, you do have to qualify medically. So meaning it's going to be based on your age. It's going to be based on your prescriptions, your health history. There are people that will not qualify for this because of their health history, unfortunately. And then another thing is, there are insurance charges. So because you are buying insurance, there is a cost to that actual life insurance death benefit. So what that means is if you put in $500 a month into this account, not all $500 is going into your basically your savings account. Some of that money is going to pay for the actual insurance. And we're going to get into an actual illustration of what that looks like. But that is one of the downsides to this. Okay, so let's take a little break there. Is there anything that I went over too quickly that you want me to explain again? Okay. Leanna, I know you're brand new to this. So Leanna just passed her test Monday, Tuesday.
Hey.
Yeah. So she's definitely brand new to this. So, obviously, Leanna, this is a little bit more advanced, but I'm going to tell you this, because I know you're what, 20 or 21, people your age. This product is unbelievable. You show it to any of your friends and they will buy it 10 times out of 10. I guarantee it, because the younger you are, and for children as well. I mean, you show this on a child, honestly, under 10 years old or anything like that. It is unbelievable. And I'll show you what that looks like. Okay. So the Alliance has a number of companies that do IULs, National Life Group, F&G, North American, Columbus Life. I'm sure that Mutual of Omaha, I know CFG is going to get one here soon. There's plenty of them out there. I'll be honest, I'm most familiar with National Life Group with their illustration software. So I'm going to use them just to kind of show you how this all works. But just know it's about the same with all of them. And kind of whatever one you want to use is personal preference. So log in. There. Oh. Now we got some people coming in here. Let's see who we got here. Big Charles looks like. What's up, Charles?
What's up, Big Dan? Thanks for the invite, my man.
Yes, sir. Yes, sir. All right. So we talked a little bit about Charles, like what IULs are and things like that. And Charles actually has sold quite a few IULs. So Charles, is there anything you want to add? I know you missed the whole first part, but in your experience, why do you prefer the IUL? What do you find is the biggest selling point that when you say it to a client, they instantly want it?
It's a couple of things. First of all, I don't mention insurance. And this is basically with warm market. It's different if if it's elite, but with warm market, it always comes up of some detailed portion of the IUL. I bring that up. Like the last one I saw was, hey, you know anything about compound interest? A lot of people, if they're not in the financial industry, have no clue what compound interest and that there's different types of interest and how they're credited to your principal amount. So that sometimes can start a conversation. Savings accounts, that's the big one. I sell more IULs talking about savings accounts than I do mentioning insurance. So just most people have a savings or checking account, right? So you got to try to connect them. So most people have a checking and savings account, but most of them do not know past the basic functionalities of that account, like depositing and debiting money, saving money. They don't know how the interest is credited. They don't know what their monthly charges are for that, if any. So it basically starts off something like teaching them something that they already deal with, but going into a detailed version of, okay, you got a savings account, cool. I always ask them what's the name of the bank, because even if they don't know what interest rate they're getting credited to that account, if they can tell me the bank, I can Google it. And so the conversation stems off of, hey, savings account. And I showed them how the savings account they have right now works versus the savings account that I use. And that right there is the segue into, hey, this savings account is life insurance. But at first, it's always just something simple, like whether they know about interest or whether they know about compound interest. Do they know about, if they got a 401k, do you know about market volatility? Have you ever lost money in it? So it's just basically something, when you know what an IUL is and you know how it works, you can talk about its attributes versus what it is. You know what I mean? You can talk about its functionalities. And when I use the IUL, I always do like an example of having $100 deposited into their savings now versus $100 into mine. And that right there is how I give them a little layman's example of how they work.
So if I hear you correctly, it sounds like you're saying, most people have no idea that you could have a retirement program through insurance, right? And so it sounds like what you're doing is hitting the high levels of what the IUL does without saying, hey, I'm going to sell you an insurance policy, but more like, hey, like you said, the compound interest. And then obviously once they know what it's going to do, then you get into, okay, actually we do that through an insurance policy. Here's how it works. Here's what you get. Here's why it's unbelievable. Is that right?
You are hearing me correct. Okay. I try to take it. Most people didn't know, and including me, I didn't know that you could do this with life insurance. I never associated life insurance with a savings policy. I never associated life. Honestly, before I started selling insurance, I didn't know, but I was only thinking about death insurance.
Yeah.
I didn't know that that insurance has such vast array of policies and products that offer retirement solutions, stuff like that. So what I do is find something that they already have. In my report building, I'm finding out what they have, where your money is, and then I find out if they know how that money works. Do they know where you've been putting your money? Are you just saving it, or do you know how interest credits? And that's what I do. I'll teach them something about something they already have, and then let them know, hey, what I have does the exact same thing except for this. So I basically teach them what they have, teach them, the intricacies of what they have if they don't know. And if they do, it makes it even easier for the segue to go, hey, well, I got an insurance policy that's like pays, on average 8 to 10% versus this 0.01% you're saying. And they'll blow their minds. If they know number, they're like, wait a minute. Especially with $100, they're like, okay, 1% on $100 or 10% on $100 versus, 8.5%. Like that's a whole shit ton better. So yeah, that's what I do. I don't mention insurance at all because I don't want to give them paralysis of analysis by telling them, hey, this is insurance. Because in their mind, if they're like me, you just stop the conversation because I'm not, you just made me realize I'm thinking I'm paying something that somebody else getting the benefit. What about me? We talking about savings. You don't talk about saving for dead people. We talking about life insurance. But I don't let them know about the life insurance part until I start going over what they have. Because then, Section 7702 of the tax code allows you to get the tax-free. I don't say that up front. They don't even know what the hell I'm talking about. Tax-free, what do you mean? I got to show them how they're getting taxed by this interest first.
So what about, you said that's with warm market. What if you're sent with a lead, right? Are there any phrases or anything that you use to transition to start the conversation about, and I'll tell you what I say, but what do you say about how, just kind of, say you sat down, you helped somebody, they're 30 years old, you helped them with a term policy to pay off their mortgage. They're happy. They've made you cookies. You've got a great rapport with them. Mm-hmm. I think for a lot of newer people that it's almost scary or intimidating to say, how do you even start talking about their retirement? Like, what do you?
Well, what I would say, if I'm sitting down with them, I've already sold them a term policy because yes, usually the IUL is not going to happen on the first sit down. because they don't even know that IULs exist. They don't know that savings exist intertwined with the insurance. So after that, and I've sold the policy and I come back, I come back and let them know, hey, I'm just checking on you, man. It's been, 6 months. Some questions I didn't ask you. I keep my green sheet. So I'll go back to my green sheet and go, hey, you said that you had about $10,000 in the bank. I mean, what are you doing with that $10,000? I'll try to find out what their goals are for what they're saving. And that's how I get into presenting my product. I try to find what they have first, because they may not need what I need. And then I don't want to just talk to somebody that doesn't even need, I'm not wasting nobody's time. So you find out if they're even at that age 30, if they're even thinking about retirement. And if they're not, you might be the one that educates them on the importance of retirement. And then you go back to those accounts and show them, hey, you cannot save your way to $1 million like this. Let's use your account, your savings account, and the interest rate you get. In 20 years, if you put in this amount, this is what you get. Is that enough for you to retire on? You know what I'm saying? So that comes from finding out if they're even interested in saving money. Because you might run into some people, a lot of them, they just spend. Some people I met a lady last night, blew my mind. She's a business owner. She actually owns 3 businesses. And she is not saving for retirement. I was like, what? She was like, I thought maybe she was kidding, but she really wasn't. She actually didn't know how the accounts that she had worked either. She didn't know that she was getting, 2%. She didn't know that she didn't know until, I don't know if I believe it, but it blew my mind. She said she didn't know that saving for retirement was something that was important until I mentioned it to her. And the craziest part, she's got an 80-year-old dad who I'm talking to about annuities. And I asked her, didn't you see what your dad do? Because he has like $300,000 in different accounts. I was like, did you not look at him? And she's like, oh yeah, but he retired from 3 different jobs. I was gonna do the same thing. I was gonna work till I died. And I was like, wow. So then it became she was like, wait a minute. So I know how savings accounts work, but they save slow. So there's something I can do with the same amount of money, but put it in this, and it does that. So yeah, it is. You got to find out what they're personally doing, because I'm sitting there talking to her about IUL, and when I finished, realized she didn't give a freak about saving. The person that she had brought was the one that was interested in savings, but the person she brought, I had never met him. So I was talking to the wrong lady, and they let me talk to her. So the lady that wasn't interested, that actually brought the friend, let me talk to her. Then when I was done, she was like, yeah, I'm not, that's who you want to talk to. And I talked to her, but then at the same time, because that happened, that other lady was like, wait a minute, I just learned some things. I'm interested too. I got money sitting places. And I was like, yeah, okay. So then, so it came into that. And I was like, that's when I found out she had not even thought about retirement. She thought she was going to save her way to retirement or just keep working and like her dad did.
Yeah.
So, yeah.
Yeah. And to be clear, because you did mention something earlier, and I just want the newer people to understand is, you don't have to have money to start an IUL. So like with annuities and things like that, you have to have a little bit of a nest egg that you're working with. With IULs, you could have 0 money in the bank, right? So an IUL is a savings program. Think of, the main difference between IUL and annuity is an annuity is for someone that already has a savings plan and they want to protect it. So somebody that has worked their whole life, they've got $300,000 in a 401k. Now they're worried that they want to start living off it. They don't want to lose it. So a way to protect it would be through an annuity. The IUL is somebody who wants to start to make a savings up to that 300,000 or whatever. And so, I think why Charles asks if they have anything in the bank is he's worried about people who are actively looking to save money, right? So if someone's already saving money, you show them this, it's a no-brainer for them to stop putting money into a savings account and start putting into this. So what I would like to do, like I said, I mentioned there are quite a few different carriers that we use for IULs. I'm most familiar with National Life Group, so I'm just going to use them for the illustration. Leanna, are you able to talk or are you unable to talk?
Hi.
Oh, Johnny.
Yeah, Leanne had been using this computer to do her test with, and so I pulled it up this morning. And of course,
Okay. Well, I was
sorry,
trying to.
Leanna, so I didn't try to change it. So
That's okay. I was trying to get somebody young. So no offense, but you're a bad example.
Well,
Got him.
I'm young.
So we'll do Guy. Guy's pretty young.
Hey, let me say something, Dan.
Go ahead.
Pretty young. What you talking about?
There's one thing that I wrote some, IULs in the past, not any recently, but one of the things that they did bring up sometimes is you get a client who is not very healthy, and they can actually do an IUL on a grandchild, or a parent can do a child. So that allows them to get into that marketplace, even though they're not healthy, and they can manage the account.
Yeah, absolutely. Right. Or a spouse. Right. Or
Right, exactly.
yeah.
Hey, Dan, I want to add this too before I forget, if you don't mind.
Go ahead.
Another segue into IULs, period, is if they say they're looking for insurance, but they're not looking for savings portion, don't even know anything about it. My major selling point, I don't know how I forgot this, is I will tell them about the living benefits. That's how I get into IULs, because already they don't already know. They know that you're talking about something, a product that's different and they never heard of the IUL. So let's teach them something that they didn't know about insurance anyway. And that's the living benefits. I've sold more IULs off living benefits than anything else. I don't know how I forgot to mention it.
Yeah.
Even though all insurance policies have living benefits, most people don't know about them. I use that to, why not, since we're talking about a new product, or I'm finna introduce a new product, let's add living benefits into it. And that's what they're going to remember as being the main benefit of that policy.
Yeah. And you're right. And, actually the nice thing about National Life Group is on their illustration, it's on like page 1. It has all those, and we'll kind of get into that. But all right, Guy, I'm going to use you as an example. Can you guys see the screen okay, or do I need to zoom in or something?
You could zoom in. Hold on.
Okay, now I figured it out. There we go. Is that better?
I might look a little weird because I got to flip my phone sideways.
It's not letting me like move anything.
Anybody that's on their phone, I don't know if it works for everybody, but I got an Android. You flip the phone sideways, you can actually take your fingers and zoom in on his screen from your phone.
Yeah.
All right, so we'll put Guy. His last name is Ford. And Guy, what is your what's your date of birth?
3593.
All right.
That was wrong, man.
And so, Deb, with the beauty of this, the softwares, you don't really need to know anything, right? So the illustration software kind of does everything for you. Only thing you're going to need to know is how to operate the software. And obviously we're going to help you with that. And it's, the more you do it, the better it is. But, like I typed in his birthday, it popped out the age, right? Rate class, depending on what they're doing. So the cool thing with a lot of the carriers is this rate class, this just shows what it's going to illustrate at. And so what that means is, if you remember, I told you, one of the downfalls to the IUL, or one of the cons, is there is a cost of insurance, and how much that insurance costs is going to be based on the underwriting and what rate class the client comes back. Now, so as you're doing the illustration, this is just for illustration purposes. Meaning, if I do standard non-tobacco and Guy's underwriting comes back and he's elite, they're going to give him the elite, and his illustration will be updated to the elite rate class. So I always like to do standard and show them less numbers, and then when it's going to be, then show them the best of the best, and it comes back in their standard. Does that make sense?
Makes sense.
So I always do standard. This stuff, you don't got to worry about any of it. Then we just go on over here to death benefit and funding. So now you don't have to worry about any of this stuff. This is all fine. 99% of the time, you're going to do an IUL to accumulate cash for retirement or for anything like that. So we want to make sure that we have minimum death benefit, max cash. What that means is based on the money we're putting in, we want our money to go to the least amount of death benefit possible and the most of our money to go to our cash savings as possible. So minimum death benefit, max cash. Now you come down here and it's going to ask about how much do you want to pay? And, you know, when I started doing these, a big red flag that I was doing is I was asking people, how much do you want to pay? And people didn't have a grasp, or maybe I wasn't explaining enough, that this is a savings program. And, you know, ultimately when you're showing them what it is, you know, the thought process for them should be, well, how much can I put in it? Not what's the minimum, right? It's almost like, hey, I want the most money possible for when I retire, my savings account. They're not going to say, well, you know, what's the least I could put in? Like the mindset needs to be, what's the most I could put in? And now obviously everyone still has a budget, and obviously I get that. So the easiest way I found to figure out how much they should be putting in is just by asking them a couple of questions. So Dodge, I'm going to ask you a couple questions. Obviously you don't need to give me your real answers, but for this, we'll just go with it. So I would say, now Guy, would you agree that, most financial experts suggest that to have any real retirement savings, you should probably be saving about 10% of your annual income?
Yeah, I agree.
Okay. And just a side note, typically people will say at least 10%, if not more. Here, somebody's really loud. Who is it? Is it you, Guy? It is you.
It is me.
I'm not sure.
I mean, there's nobody here. I don't have any background noise.
Okay, there we go. Interesting. Okay, so Guy agreed that 10% should go to retirement. So it's just as simple as saying, all right, well, how much do you make in a year?
About 80,000.
80,000. So that means we need to be putting in $8,000 a year into his savings plan. Okay. And you could do it on an annual basis. You could do it on a monthly basis. What is 8,000 divided by 12? It's about, wow. Okay.
I'm thinking.
All right, guy. So,
Where you at?
let's just say $666 a month.
Is that what it is?
That's what it is.
Okay.
Okay. Now, so we're going to specify the amount, $666 per month, right? Now this over here is saying, how long do you want to pay that? And most people, they want to pay until they retire. And so what's really neat about these illustrations is you could actually, if he says add row, he might say, hey, I want to pay $600 now. And then I want to pay only $300, in 20 years. So you could change how much he's actually going to pay. You could illustrate that. But for now, let's keep it simple. And so this one is policy year one. And let's just say he wants to retire at age 64. So we could put A for age 64.
Okay.
So this means he's going to pay that $666 from today until age 64. Okay. Then when you come down here to distribution, this is how do you want to get the money? I'm going to leave that blank for now, and I'll come back and I'll show you what we could do. But the software has all of the information that it needs. So all you do is just come over to this quick view, click on that. And what it's going to tell us is how much insurance he gets. So $645,000. So what that says is based on $666 a month. The minimum amount of insurance he could have is $645,000. Okay. So selling point number one, guy, you have $645,000 of death benefit. You die tomorrow, Brittany and the kids get $645,000.
Right.
You know, you made one payment of $666. You know, so it's a wealth creation tool. So comparing that to any other savings program, you put in $666, all you have is $666, right? So Deb, what we're looking at is going to be these accumulated value. Actually, hold on. Basically,
Wow,
this,
you just blew my mind with that one, Dan. That's
so
good.
surrender value. Okay. They're about, yeah. So this column right here, that's going to be your cash. Okay. And so if you remember, we said the first, I don't know, 10 to 15 years, this policy, you pretty much break even. So if you're planning to use the money within 15 years, this is not the policy to use, right? Because this is using compound interest. So you need that interest to compound to get the growth of it. And I'll show you exactly how I sell it too. Hold on. Hold on one second. Oh. It's his allergies, man. Okay. So he's going to pay essentially $8,000 until age 65. So as we can remember, the surrender value is what we're looking at. And if you remembered the cash value, or they're calling it the surrender value in this instance, that is always just a collateral or equity that you have against the death benefit. So, and we'll get to it in a minute, what that actually means. But this cash value in any life insurance policy can never be more than the death benefit, right? And so what happens is, in Guy's instance, his death benefit's going to grow because his cash value is going to get so high. And I'll show you what that means. So you could see when he's 56, the death benefit starts growing because that cash value is getting pretty high. Okay. So at age 65, so he's paid into it. He has over $1 million worth of life insurance and $842,000 in his account. Okay. He's not paying on it anymore, and it's still growing. Right. So what I always tell my clients is, if you have other investments or other savings programs, use them first, use the IUL last, because now that it's been 35, 40 years of compounding, Guy's in the sweet zone, right? Where every year, I mean, he's getting almost like 100,000, 200,000 down here per year. It's compounding, right? And so you want to use everything else first, use the IUL last. And let me show you something cool that we could do with this. So he could take that money, he'll have $842,000. He could take as little or as much as he wants. What I like to show people is this distribution. We could solve that for income, which means we want to start taking money at age 65. Let's just, M means maturity through the rest of his life. What this is going to show us is basically how much he could take for the rest of his life. Okay. And I'll show you what that means. And then this is the selling point. This is where I always get people. Okay. All right. So he's paying, can you see the calculator on there?
Yeah.
Okay. So you're paying $7,992 for 36 years, right? Do you see that down here?
Yep.
So that means you're paying into it $287,000 total is what you're paying into it. Okay.
Right. To
So,
get.
well, here's what you get. You ready? At age 65, you're going to get almost $64,000 a year for the rest of your life. Okay. So remember, you paid into it 287.
Right.
You're now getting 60. When I'll do this math together with you. Oops, sorry. Oh boy. Oh boy. Oh boy. Oh boy. Here we go. Okay. So what I always show my clients is you're going to get 63,934. Average life expectancy is right around 85. So let's say you take that for 20 years. Okay. Remember, you paid into it 287.
Yep.
You're now getting out of it 1,270, or I'm sorry, 1,278,680 tax free. And say you died at age 85, you took out 1.278 million. Your family gets $491,000 of life insurance, also tax free.
That's crazy.
So you're looking at, let's say,
You're about $1.7 million in benefits.
and you paid $287 or 287,000.
Yeah.
Right. Tax free. What if you live longer? What if you live less? It's all proportionate, right? I mean, it's to me, it's the most insane thing I've ever seen. Right. And then now,
Again,
Yeah.
excuse me, can I ask you a question? Hold on,
You can.
You got cut service.
So we're drivers. We lost the service. You paid in $200-some thousand. What was the balance at the end?
yeah, you paid into it 287,000. If you lived for 20 years, you would get basically $64,000 a year, which that times 20 years is 1.278 million.
Yeah,
And then also there's right around $500,000 of life insurance still left in there. So like 1.8 million is what you're getting out of the policy. You paid in 287,000.
oh, great. Thanks.
Dan,
Yep.
Dan, I got a question for you.
Go ahead.
Over here on where it says guideline single 129, 145 on the left of the screen.
Over here. Yeah. Okay.
Is that if they did a single premium pay?
Correct.
So if they shifted 129,000 over there at that age. And
Yeah,
let it sit.
it's kind of right.
Is that
Because what it's saying is the 31,000 would be the max you could put in to not break those tax laws, the 7702. I'll be honest, I don't know how that guideline single works. I'm not even gonna lie. I have no idea. I've never done that, but
That'd be a good question.
yeah, it would be.
I don't know either. I just saw it over there.
I'm assuming you're on to something. I just don't know how that actually works. So, I mean, because here's the thing is you could set these up. So, okay, I guess what it means is you could set that up as a non-MEC, right? So, or I mean, modified endowed contract is MEC. You could put in the 129,000 and get these results, but you're going to lose the tax-free benefit to it. I guess is what that's saying.
The way my understanding was they won't allow you to do that because it messes them up. So there's got to be maybe some way around that.
You're going to have to pay taxes and do a bunch of weird stuff. You're better off if you have 129,000, you're better off just funding this with that money on a monthly basis. Does that make sense? Putting that 129,000 into a savings account and then just have these monthly premiums come out of that savings account instead of putting it all in at one time. Does that make sense? Or you lost on that?
No. It makes sense. I was just wondering, because, sometimes it's just like doing a single premium life insurance policy where
Exactly.
they get the value of the policy from day one.
So these are, Charles touched on the living benefits. Basically, and what I love about NLG is they show it right on the first or second page. So start paying my policy, $666 a month. If I die tomorrow, my family gets $645,000, right? If I need cash. So basically this is saying at age 65, guy's going to have $5,328 on a monthly basis of retirement. That's kind of what we went over earlier. That's $64,000. And you can kind of just see what the value is of the policy, right? This is crazy right here. So critical injury, critical illness, chronic illness, terminal illness. If your client has any of these issues, this is what gets paid out to them. These are the living benefits, right? What if someone has a major heart attack? What if somebody, gets diagnosed with terminal cancer, right? Like Charles said, that's a huge selling point to people of you could use that money while you're still alive, right? And the whole point of this is, I love what Charles said earlier, maybe a couple of days ago. Like this is life insurance, or what did you say? Not death insurance, but Charles, I forget how he said it, but he said it real nifty.
Yeah. When I talk to them, I find out if they're talking about death insurance or life insurance. So when they tell me what they have, I say, okay, so you're talking about, most of the time they're talking about death insurance. They're like, what? And then they're like, well, what the hell is life insurance then? What's the difference? Now we talking. You know what I'm saying? Now they're receptive to learning something that they didn't know because they thought they knew it.
Yeah. All right. Let's I want to show you kids one, because this I always ask clients, hey, do you guys have any Head Start programs in force for your kids? What do you mean? Savings programs for college, or for down payment on a house, or even their retirement. I know they're only 3, but they have so much time that they could really do something. One thing I want to touch on that I meant to say earlier and I forgot. With really any savings program, the more time someone has for it to compound, right, the less money you need to get the same results as. So the more time, meaning the more years, the less money you need. The less years, the more money you need. Are you tracking with that? So like, say the end goal is you want to have $1 million in the account. The younger someone is, the less money you need to put in on a monthly basis. The older someone is, the more money you have to put in. It's pretty logical, but for this, instance, it's why the kids' policies are so incredibly attractive. Charles, how old is C4?
C4 is 4 years old, my man. Speaking of which, look at this guy. Hey, Charles. It's so funny. He's trying to say, hey, Uncle Guy. He can say Guy by itself, but if you put Uncle in front of it, then he says Uncle I. Yeah.
What's up, little man?
He chilling though down here.
Okay, so a 4-year-old. All right. I always like to start off with just $100 a month as a base. And we're going to do the same thing we did with Guy. So age 1 through, or year 1 through age 64. We'll do the same thing for the distribution, 65 to maturity. Yes. So where Guy had to pay $666, now because C4 is so young, his insurance is so inexpensive. So this is why, he's only getting $188,000, right? Because we're only putting in $100 a month, right? But if we look at this surrender value here, $100 a month means when C4 is 18 years old, he's got 20,000 in that account. When he's 30, he's got 56,000, right? And we're just talking about $100 a month. And as we go and we go, age 65, 538,000. So we're paying $100 a month, $1,200 a year, 538,000 in the account. So let's get out the calculator again. 1,200 for 61 years. You paid into it 73,000. There's $538,000 in there. More impressively, you paid in 73,000, but C4 is able to take out $43,791 a year for the rest of his life. So let's do the same thing we did with Guy. 43,791 times 20, $875,000. How much did he pay into it?
73.
Right?
Hey,
Well-
another cool selling point about this too, Dan, before I forget, because I'm starting to remember some things while you're talking. Since you control the surrender account, another major selling point about this, and this is huge. At some point, if you don't want to make that $100 payment anymore, you can tell them to just take it from that surrender account and keep going.
Yeah. And so, these are so flexible, right? Again, because universal life, you're able to pay as much as you want or as little as you want, right? You get to the point where, to Charles's point, like essentially that's what we're doing at age 65 is we're saying, we don't want to pay it anymore. Just take it from my surrender value. And because the compounding interest is so high at that point, it's like 10 times what the insurance amount is, right? So you're not even worried about it. But yeah, and it doesn't have to be age 65. Some people want to retire at 75. Some people want to retire at 55. And then also this is just an illustration. So just because you show somebody this doesn't mean this is what the policy, it doesn't mean they have to retire at 65. They could retire whenever they want, but this is just showing, hey, if you do this, this is what happens. But you could always go back and revisit it and change it and whatnot, right? As I mentioned, this is liquid essentially day one. So, at age 18, he's got 20,000. He might need 10,000 for something, right? He's going to have access to that money where every other 401k or Roth IRA, 403b, any of those, he can't touch that money until he's 59 and a half. Right. So here he's got liquidity to it. And the crazy thing is how it actually works is you take a loan. So your money's still going to, so say he takes out 10,000 here, this column still grows the same way as if he never touched that money. Because technically he didn't. They just let him borrow against it. You're using collateral against your collateral. You're using your equity as collateral, basically. And so, Deb, just so you fully understand how cash value works, and this is the same with any insurance policy. Once you take money out of the cash value, you're basically taking it from the death benefit. So you could see here where we start taking money, the death benefit actually goes down because that's where that money's coming from, right? You're accessing the death benefit while you're still alive. And again, the whole point of this is we don't really care about the life insurance, the death benefit. That's not the main selling point. The main selling point is tax-free retirement. That death benefit is just an added benefit. but that's where that money's coming from. Does that make sense?
Yes. Yes.
Good.
Yeah.
Okay. So questions, right? Because we could, or is there anything specific you guys want to see, or you were curious about, or just wanted to know about?
Matt has a question.
Can
Go
you
back.
pay it back to the death benefit, bring it back up?
You can, if you want to. So typically in retirement age, you will not, right? Because your compounding interest is so good. Now, if we go back to C4's example, one thing he could do is, so let's just say at age 26. So a cool thing he could do is he'll have $41,000 in there. This is what's called self-banking or infinite banking. Say he wants to buy a car. Let's just say that car is $30,000. Let's say he's got terrible credit or doesn't want to use credit because he doesn't want to pay that high interest, right? What he can do is he could essentially take 30,000 from this 41,000, make payments to himself, right? So think of it this way. I'm gonna use my hands. Pretend this is a car. I can't see it. Okay, hold on. Use my hands. So in a normal transaction, if you go to a car dealership and you want to buy a car, the dealership has the car. You have the money. Okay. What happens is you give the dealership the money. They give you the car, right? They have the money. You have the car. End of transaction. With infinite banking or self-banking, it's your money. You're financing yourself. So what you could do is take out 30,000 from your 41,000. Instead of making payments to a bank or a dealership, make those payments to yourself. Make yourself whole of that 30,000. So at the end of the transaction, you have the car and you have your $31,000, $30,000. Does that make sense? Isn't that just wild? Right? And it just, this is what rich people are doing. This is what the 1% do, right? To be honest, here's a funny stat. 97% of people are in some type of 401k or IRA. And yet there's a 1% that are wealthy. Do you see the correlation? The 401k will not make you wealthy.
So Dan, is it because you're using that compound interest or the surrender, the cash that you've built up that technically isn't your money? It's the interest and whatnot that's been built up. Is that the concept of paying yourself? Or
Well, so the reason you'd want to pay yourself back is because if you take out that 30,000, you ultimately, it's coming from the death benefit. So think of it this way. So say you took out $30,000 at age 26.
right.
Okay. Well, when you go down to, let me find a good example right here, 333,000, it will still grow to that, but you would have already taken out 30,000. So in essence, you would only have $303,000 there.
Okay.
Does that make sense? So that would be the only reason of why you might want to pay yourself back. Now you don't have to, right? You might say, hey, I'm good with just 303,000. Right? But you could also pay yourself back to have that 30,000 down the road.
Okay.
It's up to you, right? And that's the beauty of it, is you don't have to, but you can, right? Or say you wanted to get into the investment world, real estate investment, right? Say you needed 30 grand for a down payment on that rental property. you essentially have the renters pay that money back. So you get made whole again. So at the end of transaction, you've got your 30,000 back. They bought you a house. You could sell it. And now you're clear 500 grand. And you didn't have to go through a bank. It didn't matter what your credit was.
Okay.
It
Okay.
didn't matter.
I see. You're loaning through yourself.
You're self-banking.
Gotcha. Okay. That makes sense. Okay. I just needed to hear those words.
Yeah.
That makes sense. Gotcha. Okay.
Right. And it's you're leveraging your money, right? Because here's the thing is, anytime you leverage someone else's money, you're paying for it. Right? You're paying for it. Think of a credit card. You realize most credit card, people don't even know this. Most credit cards are in a neighborhood of 18 to 26% interest. Because they know Americans, including myself, don't grasp these concepts. Right? Aren't frugal enough to make these decisions. You know, we have wants and desires that we put ahead of ourselves because we have to have it now. Have to have that iPhone now. I'm showing it there. You know, even though Verizon is charging me, I can listen. Verizon's going to say, "Hey, don't worry. Paid over 2 years. Don't worry. Don't worry. $50 a month over 2 years. Don't worry." Even though I'm paying now $1,200 for an $800 phone.
Right.
Right. And so this is what people do this is the whole essence of how banks exist. It's how life insurance companies exist. Right. They're selling their money. This way you're using your own money. And if you think about it, how you could use it to fund everything, right? So, look, so C4 at age 65, it's going to have $538,000, right? He could literally buy 5 or 6, we're at the beach. So he could buy 5 or 6 condos, beachfront, with that money. Doesn't come from his checking. They don't do any credit checks, nothing. His money, right? All the money he gets from it, he could put back into this if he wants, all the rent money, be made whole. Say he gets us back up to 538,000. And then he could sell everything he bought to get clean money, do whatever he wants with it. I mean, the possibilities are just endless.
Yeah. When you can explain it like that, very simple. That is crazy.
Right. And just the power of, there's no underwrite. It's your money. You literally call them up and say, put this in my account or mail me a check for 500,000. No questions asked. Right. We've all been in the process of buying a car, or buying a house, and everything is outside of our control.
Yeah. Okay. I see that.
Right. But people don't know about this. They don't teach us in schools. I didn't know about it. Right. Until you actually see it. You get around it and then you just show people, open their eyes to it. It's like, wow, what are we doing? But think of it this way, Guy and Charles. We've all been doing this for a while, and, we'll have annuity talks with people and we'll see their accounts. What do you think the average statement is on a 401k? Charles, what do you think? I think, honestly, my average I see is about $60,000 that people have saved for retirement.
Yeah, I was going to say about 65, 70.
Right? How rare is it to ever see someone with 500,000, $1 million, 700,000? It just doesn't, because people don't know about it. Right. And they're doing because the thing with everything else out there is it's risky. Right. And even though this is a slower savings, because you never lose money is what makes it so lucrative. Anywho, so Deb, I know you had some, just some general questions about IULs. Did that answer a lot of them, or do you have anything specific you want to ask?
No, I'm good. That pretty much covered it.
There's a lot to it, but they're very basic. Keep it basic when you're trying to sell it. Like Charles said, talk about, hey, you ever heard about compounding interest? Where are you saving now? I think I might have something better that can help you. I've got something that might benefit your saving goals. And then you call up me, you call up Adam, you call up my brother, anyone, and we help you with it, right? And you don't need to know everything right away, right? Like I told you before, just make a friend, build that relationship, and then call one of us and we'll help you out. So that's IUL. I love them. Sell a good amount of them, especially to kids, right? Because $100 a month, grandparents can afford it, parents can afford it.
Okay.
Charles, Guy, any last words?
Nah, that was huge clarity right there on just the overall benefit of what you can get, especially now, putting it on a child and allowing the parent to be, the owner. And now, so as far as like a parent owning a child's policy like this, prior to 18, I would assume the child would take over ownership of the policy.
So the parent or guardian or whoever the policy owner is,
right,
they have full control. They can do whatever they want, but they are able to transfer ownership over to the child.
Gotcha.
So,
so if I were to have a policy out on Maddie, or the new baby, even if they were 30 years old, I could stay in charge of the policy, and I could be the one to benefit from the 56,000. I mean, is that?
Yeah. And that's to Johnny Jackson said that earlier is, the downside to this is you do have to qualify medically, right? So say you're a 29-year-old who couldn't qualify for whatever reason. That is one of the options that you could do is set it up on the child, but it's really for you. Like the child wouldn't even know it exists, right? But it would be just for you. So that is an option. But yeah, I mean, obviously most people are looking to transfer this to their kids.
Yeah, no, of course. Or set another one.
That's a huge selling point because I've actually used that to bring it up. I had a lady, she's like, oh, I'm just too old. She was smart. She knew numbers. She knew compound interest. She did not know the IUL existed. She didn't know the benefits of the death benefit being available from day one, making a payment. She also didn't know that she could use her granddaughters because she had like $500,000 worth of life insurance on her daughter, all her kids, but not the grandchildren. Didn't think it would be beneficial at her age to start investing in one when I showed her the numbers. But because I knew that, hold on, buddy. Because I knew that I could pivot, I use it as a selling point. Say, hey, but you can start over at your granddaughter's age, and you being the policy holder, we just can't go over 500,000. Broke it down to her, and she was like, huh. And so I sold it, and I was like, man, I'm glad I thought of that. But from now on, remember that and put that in the arsenal because you might run into somebody that's like, I'm too old, but I love my grandbabies.
Right.
I'm interested in the policy, but
and I think too, a big thing to remember is when you're selling this, and it's very analytical. We're looking at numbers. It's going to bore a lot of people. So do your best to be very enthusiastic, right? And just be like, wow, look how awesome this is. Just, you understand, right? Just be not over the top, but get them excited. They're going to feed off your energy and they're going to understand it more. They're going to believe in it more because you believe in it. If that makes sense.
I agree. Yeah. 100%.
But all right, guys, I appreciate it. I'll end the Zoom here. I did record it so I could send it out if anybody wants it.
Yeah, throw it at me. I missed the first part of it. So
No worries. But all right, guys, we'll be in touch soon.
Yeah, I think I
and,
hopped on 30 minutes late, so definitely send it to me.
will do. And so Deb, I'll talk to you later. Guy and Charles, I'll see you guys Monday.
yes, sir.
Nice to meet you, Deb. Do your thing.
Thanks, man.
Nice to meet y'all.
Bye, guys.
Later.
Hey, Dan,
Yeah, go ahead.
I had a question for you really quick.
Sure.
I was going to ask, but everybody else is talking. So in other illustrations, like different carriers, do they have the same option for minimum death benefit
Yeah,
and max
yeah.
cash value?
Yeah, they
Okay.
pretty much all have that. Yeah, for sure. And they might name it something like I know F&G calls it oh, what do they call it? Something accume, max accume. Basically, you'll know it when you see it. But yeah, they all pretty much have it.
Okay. Are you familiar with like Foresters?
I am.
Do you know what they call it? Because I don't remember
So-
seeing that option on there.
Sure. Well, so and let me end the Zoom here, I'm going to end the Zoom and no, actually it doesn't matter.